Everyone talks about big tech stocks like they're unstoppable, rockets numbers flying up, headlines screaming record growth, and investors rushing in out of fear of missing out. But behind every fast-rising chart is a financial reality most people never slow down to understand. Growth doesn't come from hype alone. It comes from cash flow discipline, brutal competition, hidden risk, and strategic decisions made years before the stock ever explodes. Today, we're pulling back the curtain on the financial truth behind big tech's fastest-growing stocks, not the surface-level excitement, but the real forces driving their rise, the pressures they face, and what separates sustainable giants from temporary stars. NVIDIA and the real economics of the AI gold rush. NVIDIA's explosive growth is often explained with one word, AI. But that explanation is lazy, incomplete, and dangerous if you don't understand the financial engine underneath. Jensen Huang didn't just ride an AI wave, he spent over a decade building an ecosystem so deeply embedded that competitors struggle to breathe near it. Financially, NVIDIA's power comes from extreme gross margins driven by proprietary chip design software, lock-in through CUDA, and long-term contracts with cloud giants like Microsoft, Amazon, and Google. The truth is that NVIDIA isn't just selling chips. It's selling access to speed, scale, and dominance in data centers. However, the hidden pressure is capital intensity. Fabrication depends heavily on Taiwan's semiconductor manufacturing company, which concentrates supply chain risk in one geographic area. NVIDIA's revenues are growing fast, but expectations are growing faster. Any slowdown in data center spending, any geopolitical disruption, or any credible alternative from AMD or custom in-house chips could compress margins quickly. NVIDIA's stock doesn't rise because AI exists, it rises because investors believe. Jensen Huang can maintain pricing power in a world that desperately wants what only he currently controls. Microsoft's quiet transformation into a cash flow machine. Microsoft's growth story isn't loud or flashy, and that's exactly why it works. Under Satya Nadella, Microsoft transformed from a software seller into a recurring revenue empire built on cloud services, enterprise lock-in, and strategic AI integration. Azure doesn't need to beat Amazon Web Services outright, it only needs to grow consistently while leveraging Microsoft's existing enterprise relationships. Financially, Microsoft's strength lies in predictability. Subscription-based revenue from Office 365, LinkedIn, GitHub, and Azure create cash flow stability that allows aggressive reinvestment without threatening the balance sheet. The market rewards Microsoft not because it grows the fastest, but because it grows with discipline. The truth most people miss is that Microsoft's margins are protected by switching costs. Once a corporation builds its operations around Microsoft infrastructure, leaving becomes expensive, slow, and risky. That financial gravity is powerful. The risk, however, is regulatory pressure and rising infrastructure costs tied to AI computing. Microsoft's growth is real, but it's not free. It's purchased with massive capital expenditures that only work if long-term enterprise trust remains unbroken. Amazon's growth is no longer about retail. Most people still think Amazon's growth is tied to online shopping. That misunderstanding leads to bad conclusions. Jeff Bezos understood early that retail alone would never justify Amazon's valuation. That's why Amazon Web Services became the real engine of profitability. AWS subsidizes retail, logistics expansion, and experimentation. Financially, Amazon operates on razor-thin margins by design, reinvesting aggressively to maintain scale dominance. Andy Jassy continues this philosophy by prioritizing long-term infrastructure over short-term profits. The financial truth is that Amazon grows by exhausting competitors, not by maximizing quarterly earnings. However, this strategy creates investor tension. When growth slows, even slightly, the market punishes Amazon harder than most companies because expectations are sky high. Rising labor costs, regulatory scrutiny, and competition from Microsoft and Google in cloud services are real threats. Amazon's stock doesn't grow because it's efficient, it grows because investors believe its inefficiency. Are strategic investments that will eventually compound into overwhelming dominance. Meta's high-risk bet on control and attention. Meta Platforms is one of the most misunderstood big tech stocks. Mark Zuckerberg isn't chasing growth blindly. He's fighting for control over future attention economies. Financially, Meta remains a cash-generating monster through advertising across Facebook, Instagram, and WhatsApp. The problem is that advertising growth depends on user attention, and attention is the most contested resource in the world. Meta's heavy spending on Reality Labs looks reckless on paper. but it reflects a deeper fear: platform dependency. Apple's privacy changes exposed how vulnerable Meta's ad business could be when another company controls the rules. The financial truth is that Meta is trading short-term profit stability for long-term independence. This gamble makes the stock volatile because investors disagree on whether Zuckerberg is visionary or reckless. If virtual and augmented platforms become dominant interfaces, Meta wins control. If they don't, Meta burns billions chasing relevance. Meta grows fast, not because the path is safe, but because the upside of winning control over future platforms is enormous. Tesla's stock is a story of belief more than balance sheets. Tesla's growth cannot be understood through traditional automotive metrics. Elon Musk never sold Tesla as a car company. He sold it as a technology platform accelerating a future vision. Financially, Tesla's margins once crushed traditional automakers, fueled by first-mover advantage, government incentives, and vertical integration. But competition is catching up. Legacy automakers are scaling electric vehicles, China's manufacturers are pricing aggressively, and Tesla's margins are under pressure. The truth behind Tesla's stock growth is belief. Investors price Tesla not on what it earns today, but on what they believe Musk will unlock tomorrow: autonomous driving, energy storage, robotics, and AI integration. This belief-driven valuation creates extreme volatility. When Tesla executes, the stock soars. When it misses expectations, reality hits hard. Tesla grows fast because it lives at the intersection of technology, narrative, and ambition. Its financial truth is simple but brutal. Belief can fuel growth, but earnings must eventually justify it. Apple's growth comes from control, not innovation. Speed Apple rarely appears in conversations about fastest growing stocks anymore, and that's misleading. Apple's growth is slower but more controlled than almost any company in history. Tim Cook transformed Apple into a supply chain and services powerhouse. The financial engine isn't just iPhones, it's ecosystem lock-in. Services like the App Store, Apple Music, iCloud, and subscriptions generate recurring revenue with high margins. Apple doesn't need to invent constantly, it needs to maintain relevance and control distribution. The truth behind Apple's stock growth is pricing power. Apple can raise prices, absorb cost increases, and still retain customers because leaving the ecosystem feels like starting over. The risk is saturation. Hardware growth is slowing, and regulatory pressure threatens App Store dominance. Apple's financial discipline is unmatched, but its growth depends on managing maturity without losing relevance. Apple doesn't sprint, it compounds, and that's why its stock remains one of the most trusted in big tech. Google and the hidden cost of being everywhere. Alphabet's growth looks deceptively stable, but the financial truth behind Google is far more complex than most people realize. Sundar Pichai oversees a company that dominates search, digital advertising, mobile operating systems, and online video all at once. Financially, Google's core strength is still advertising, especially search ads that capture user intent at the exact moment of decision. That business prints cash. However, the hidden cost of Google's growth is scale pressure. Being everywhere means being watched everywhere. Regulatory scrutiny, antitrust cases, and content responsibility add friction that younger tech companies don't face yet. At the same time, Google is spending aggressively on AI infrastructure to protect its search dominance from disruption. The financial truth is that Google grows not because it's expanding into new worlds, but because it must defend the world it already owns. Investors reward Alphabet for resilience, but the risk is clear when you control information. Innovation becomes a necessity, not a luxury, and that necessity is expensive. Here's the reality most investors never hear. Big tech's fastest growing stocks aren't rising because the future is guaranteed. They're rising because markets are betting on leadership, strategy, and the ability to control key infrastructure of tomorrow's economy. Nvidia controls computation. Microsoft controls enterprise software. Amazon controls logistics and cloud infrastructure. Meta fights for attention. Tesla sells belief. And Apple controls ecosystems. Growth is not magic. It's the result of risk taken early, capital deployed aggressively, and expectations managed carefully. The moment any of these pillars crack, the stock reacts instantly. If you understand the financial truth behind the rise, you stop chasing hype and start recognizing power. And in the world of big tech, power, not popularity, is what truly drives growth.